How is capital gains tax calculated on the sale of rental property? If you are thinking about selling a rental property, you might be curious about how capital gains tax is calculated. This tax can impact your profits, so understanding the process is important. Let's break it down step by step. First, you need to determine your adjusted basis. This starts with the original purchase price of the property. Next, you add any capital improvements you made, like renovations or additions that increase the property's value. Then, you subtract any depreciation you claimed while renting it out. Depreciation is a deduction that accounts for wear and tear over the years, which lowers your basis. Next, you calculate the net selling price. This is the amount you receive from the sale after subtracting selling expenses. Selling expenses can include realtor commissions, legal fees, and other costs directly related to the sale. Now let's calculate your capital gain. This is simply the net selling price minus your adjusted basis. So, if your net selling price is higher than your adjusted basis, you have a capital gain. Once you have your capital gain, you need to determine the taxable portion. In many cases, only a part of the capital gain is taxable. For instance, in some areas, 50% of the capital gain may be subject to tax. To find the taxable amount, you multiply the capital gain by the applicable inclusion rate. After that, you apply your tax rate. The taxable capital gain is multiplied by your marginal tax rate to find out how much tax you owe. Your tax rate will depend on your overall income and tax bracket. An important point to remember is depreciation recapture. Since rental properties are depreciated for tax purposes, you may owe depreciation recapture tax. This tax applies to the part of the gain that comes from the depreciation deductions you claimed. It is typically taxed at a higher rate than regular capital gains. Also, keep in mind that the outstanding mortgage on the property does not affect the capital gains tax calculation. The tax is based solely on the difference between the adjusted basis and the net selling price. Let's look at an example. Suppose you bought a rental property for $300,000 and claimed $50,000 in depreciation. Your adjusted basis would be $250,000. If you sell the property for $100,000 and pay $15,000 in selling expenses, your net selling price would be $385,000. Your capital gain would then be $385,000 minus $250,000, which equals $135,000. If 50% of this gain is taxable, your taxable capital gain would be $67,500. If your tax rate is 38%, your capital gains tax owed would be 38% of $67,500, which equals $25,650. If the property was owned jointly, the capital gain and tax liability might be split between the owners. Additionally, you may have options to defer capital gains tax through a like-kind exchange, which allows you to reinvest the proceeds into another rental property. Lastly, remember that capital gains tax rates differ based on whether the gain is short-term or long-term. Long-term gains, which apply to properties held longer than 1 year, are generally taxed at a lower rate. Understanding how capital gains tax is calculated on the sale of rental property can help you make informed decisions. By following these steps, you can better plan for the tax implications of selling your rental property.